Remember, the blockchain, you can just store 1 pixel of a 10 million page document, but the hash will detect if you changed 1 pixel. So that's why you're going to use the Bitcoin to secure information, right? Well, that's really valuable, but then wouldn't the US want to be able to control this blockchain or exert some way to censor it somehow?
Okay.
And, once banks start trading Bitcoin, like Citadel, it will probably be the most profitable product for them. If you look at all bull market major tops before a 40% drawdown since 1900, all of them could have been predicted with a 40-year lead time based on births
So you think
and immigration deaths.
That demography thing is still enforced no matter what they do to try to mess it up?
Yeah, that's right. Because if you cut the population by just 20-year intervals and you mark the peak of each cohort, it marked the 29 top, the 74 top, the 99 top, 2018 top, and the next major top shouldn't be till 2030.
Forget everything you think you know about the stock market. Tom Lee, a renowned financial and crypto analyst, just dropped a bombshell that's bound to leave you stunned. His bold prediction? The next major market crash isn't coming anytime soon. It might not hit until 2038, a full 13 years from now. Sounds crazy, right? So how could he be so confident? The answer lies in demographics, something most investors overlook. While everyone is obsessing over economic shifts and global crises, Lee points out that past market crashes were closely linked to long-term demographic trends like birth rates and immigration patterns. Think about it. Crashes in 1929, 1974, 2008, and 2018 all followed major demographic shifts. If these trends continue, we may not even be close to the peak of the current bull market. According to Lee, there's still a long way to go before the next crash, potentially decades. So if you're bracing for doom and gloom, think again. History suggests there's still plenty of opportunity for growth. Lee's advice, don't panic. The bull market could keep going strong until 2038, offering plenty of chances to profit. So before you make any moves based on crash predictions, you might want to reconsider. The numbers point in a completely different direction. This could be the best news for investors in years. Be sure to check out clips from Tom Lee's explosive interview for more insights. Don't forget to like, subscribe, and enable notifications for deeper analysis. Thanks for joining us, and enjoy the video.
The Fed's already comfortable that they've got a big margin of cushion where rates are. They're already running tight.
Right.
And now they're assessing how much damage it's doing to the economy before tariffs. And this is the thing, like we know a lot of the supports have been rolling off at the start of this year. That's why consumption's down. And then tomorrow's a jobs report, but already it's foreboding, like the Challenger job cuts ADP. If we get a 50,000 jobs report tomorrow, there's a huge question on this dual mandate because full employment, I mean, we're risking, a real collapse in the employment market. So, in a way, the bond market, I mean, I'm sure people interpret, I think is arguing the Fed is late to cut.
Okay. Why? Because of what the 10-year has done or?
Yeah, where the 10-year is with the implied, like even the odds of a May cut. I didn't see it today, but I bet you it's well over 50% now.
A cut in May?
Yeah.
Oh, I would bet it is.
Yeah. So that's a Fed that's actually kind of being now judged to be behind the curve. And so if they're cutting, it's going to be a welcome pressure valve release because the market's pressuring the Fed to do something.
Market people love to look at AAII and act contrarian to that. Last week, one of the things we were talking about on the show was how fast the bears shot up to an almost record level. Mm-hmm. What do you think about that? I know you follow AAII.
Yeah.
You look at that stuff.
I follow it, and I think from the right time frame for us is like 6 months.
Okay.
Because then it captures, because the survey is done over a period of time, and so it doesn't always capture what the market did that week anyways.
Okay.
But
it's cumulative, you're saying?
Yeah. It's kind of the same thing like when these economic surveys are done. Sometimes they're done finished by Wednesday or Friday, and then so you actually get some weird differences because of what's happened in those 3-4 days.
Okay.
So, but I remember in a prior podcast we talked about how people's time frames have changed.
Yeah.
And maybe because maybe the world's more short-term focus. But, with instant liquidity, I think that's why people can go from bull to bear, because they can act with a push button now.
Yeah.
Instead of calling their broker and getting talked out of it, an institutional world is the same way. The chart you showed about imports, it kind of highlights that we've already front-loaded the tariff war because it's China, Mexico, Canada. And then everybody else is like smaller fry. I mean, I know China's tweet or comment today is what sort of made the futures weak in the morning.
Yeah.
But
which was what? We're ready to go to war?
Yeah,
we're good?
we're going to dig in on this.
Yeah.
But I think, as you know, the problem is in China isn't in the same position as it was in 2018. So it's not as if they can fight a long economic battle here, especially because of all the things they're trying to accomplish in China itself. So I think, of course, a lot of that is gamesmanship. And the intention is, if I was China, I would say that because I'd want the S&P to fall more, because if the S&P falls enough, then the White House put comes back. So it's, the stock market is kind of caught in the crosshairs right now.
Assume you don't see a bear market coming, like a full-fledged 20%er?
It's possible because it's been a couple years, but this would have to be because there has to be a layered shock on top of this. Like if the Fed, like for instance, if somehow the Fed decides that the economy's weakening, but they choose to fight inflation and let a recession happen. So in other words, the idea is, well, we've been wanting a recession to kill inflation, like let's just let it happen.
Yeah.
Then we're going to have a big drawdown. But that would really require a Fed that decided the employment mandate wasn't important, because, a recession, once a recession starts, there's no such thing as like we can engineer a mild recession. I mean, it's like you could have a severe recession because you just don't know. Most of us think of the VIX as a spot index, like, it's measuring the expected volatility over the next 90 days. So that's what the spot VIX is. But it's actually a financial product, and people trade VIX contracts, but nobody trades spot VIX. They trade the 1 month VIX, 2 months, 9 months. I think there's even 24-month VIX.
Right.
The normal VIX futures curve is upward sloping, which they call
either contango or backwardation.
Yeah, I always get the terms mixed up. It's like starboard and port.
50,
I'll get it wrong.
exactly.
Yeah, so it's upward sloping.
Okay.
Because there's time value. Like, future VIX should be higher because you got time value money. When the VIX does the opposite, so the 1 month contract is higher than the 4 month. So that inversion is what the bottom histogram chart shows. So when it's like pointing up, that means the 1 month is higher than the 4 month.
What does that mean to you, though? How do you interpret that? That's a short-term bottom?
Well, it means,
tradable.
So what the markets have now priced in is that the volatility has an expiration date.
Oh, okay.
Yeah, right. Because now it's going to be
now you
within
can
the next
see
3
through.
months. If you have a time frame beyond that contract, then you're like, volatility's going to be lower in 4 months. And we all know if vol's down, value at risk goes up. So 4 months from now, if volatility's down, risk is on.
The market stands on the edge of a cliff. Will the Fed cut rates in time, or is an even bigger disaster on the horizon? Tom Lee is sounding the alarm. Tightening financial conditions, massive job cuts, and a flood of bearish sentiment are raising the stakes. With bond markets already betting on rate cuts, the Fed could be caught off guard. And then there's China's aggressive stance, which is adding fuel to the fire. But here's the twist. The VYX inversion suggests a surprising relief could be coming soon. Is this the perfect time to buy, or are we staring down an even greater collapse? Tom Lee isn't panicking. Instead, he's spotting opportunities amid the chaos. Yes, Tesla and Nvidia are facing setbacks, but their dominance remains intact. Small-cap stocks are being aggressively sold off, even as certain key sectors show unexpected strength. Meanwhile, Bitcoin is rapidly emerging as a global financial cornerstone, with banks turning to it for everything from data security to transactions. If Bitcoin's market cap catches up to gold's, its price could skyrocket. Lee even suggests that the U.S. might start hoarding Bitcoin as a hedge against national debt. Is this the dawn of an unprecedented financial revolution? Let's dive deeper into Tom Lee's interview to find out more.
I mean, if anyone had owned these before 2024, then they're still sitting on huge gains.
Okay.
Yeah. So, it's really any new buyers of these are down, but that's really, that'd be like shame on you because you bought it.
You bought the highs.
Yeah.
Okay.
But I look at this and I'd say, you know what? I think Tesla and Nvidia, they've been hit the hardest. Do I think that their future trajectory is worse? I actually think that they still look like great companies, and it's not like in Tesla's case, it's not like their competitive position has worsened. It's probably strengthening.
Tesla's competitive position relative to other EV companies.
Yeah, and their leadership in, let's say that there's, like, if you ask a technologist, what's the next big thing? It's going to say robots. Tesla's, country mile ahead of a lot of people on robots.
Okay.
So it's not like being down 35% has changed their competitive position.
Is the bull market over?
No.
You don't think so?
The bull market, I would be surprised if it's over. So I shouldn't say no like I know, because I don't know. I'm sorry. But I'd say the probabilities are very remote, because if you look at all bull market major tops before a 40% drawdown since 1900, all of them could have been predicted with a 40-year lead time based on births.
So you think
and immigration deaths.
That demography thing is still enforced no matter what they do to try to mess it up?
Yeah, that's right. Because if you cut the population by just 20-year intervals and you mark the peak of each cohort, it marked the 29 top, the 74 top, the 99 top, 2018 top, and the next major top shouldn't be till 2030.
So you're not...
I've seen this chart, and I'd say I don't necessarily have problems with how this is constructed.
That being said...
But the one thing I'd say is that there's wide distributions in year 3. So there's actually plenty of 20% years.
Okay.
So it's not like, because this chart makes it look like you're only going to be 5% and like you hover like...
It doesn't show all of the distributions.
Yeah, so this is because as wide the distributions are, year 3 also reflects bull markets end, and then you have a huge decline. I don't think if there's a recession, small caps outperform. So like on that downside, I don't think it's protected. But if we look at the composition here, I actually am surprised it's done so poorly, because, for instance, healthcare's the best performing sector year to date, and you can see healthcare is a bigger weight in small caps. Financials have done well year to date. It's a bigger weight in small caps. Industrials have outperformed year to date, and it's a bigger weight. You have less exposure to tech.
So what's weighing the small caps down this year?
I think it's the push button, because
just people saying sell small caps.
It's higher beta.
Yeah, so they're derating. They got cheaper.
Okay.
Oh, wow. Small caps are down 15% in a 50% drawdown. I didn't realize that.
Yeah. So that it's not like someone's doing relative value. As you know, what's working this year is like financials, industrials, healthcare. That's like that's already more than half of the Russell. So it should be a good index, but and I think the individual stocks have been, but as an index, hasn't worked.
How are we getting to 5 million?
Now that's
slowly.
Yeah.
And then all at once.
Yeah.
By the way, if you got to 5 million, because we have a grid to show it, it's that gold would be doubled in price.
Daniel, previous chart.
Yeah. Gold would double in price.
So this is if crypto reaches parity with gold in terms of market cap?
Yes.
Okay, it's not there already?
No, it's only 10% of the value of gold.
Wait, what? How much gold is there in the world?
There is
10?
$21 trillion of gold.
How much crypto? 3?
Bitcoin's 2.
Bitcoin by itself is 2.
Yeah. However, I heard something interesting, and I didn't realize gold has outperformed the S&P 6 of the last 7 years.
Yeah.
So
quietly too.
Yeah. So gold isn't a bad asset class, but Bitcoin. So I think even if it's not like millennials need to buy gold for gold to go up, you just need the boomers to hold it.
You need central banks around the world to buy it and hold it, which they are.
That's right. If Bitcoin becomes the backbone of a new financial system, which it really is, it's the king of the remittances. It is the immutable blockchain, and people have a lot of reasons that they trust it. In 14 years, no one's broken it, and there's no replacement. Then if the U.S. owns 1 million Bitcoin, they'll be the largest holder of Bitcoin. Let's say that it becomes 10% of people's net worth, and banks start to use it to secure information. Because remember, the blockchain, you can just store 1 pixel of a 10 million page document, but the hash will detect if you changed 1 pixel. So that's why you're going to use the Bitcoin to secure information, right? Well, that's really valuable, but then wouldn't the U.S. want to be able to control this blockchain or exert some way to censor it somehow?
Okay.
And, once banks start trading Bitcoin, like Citadel, it will probably be the most profitable product for Goldman and JP
because of
Morgan.
how volatile it is.
Yeah.
Bid-ask spreads are wider.
Correct. And if
Okay.
oil's traded 400 times, Bitcoin might be 1,000 times. It's going to be a hugely traded commodity.
The market is in turmoil, with stocks like Nvidia, Supermicro, and Dell plunging as Singapore's probe into restricted chip shipments to China sparks fears of tighter regulations. At the same time, Bitcoin has dropped by $10,000 in just one day, following President Trump's unexpected shift toward a strategic cryptocurrency reserve, a move that has left crypto experts uneasy. Meanwhile, a weaker-than-expected jobs report and new tariffs have stoked fears of stagflation, putting pressure on the Federal Reserve's next steps. However, Tom Lee believes this wave of volatility isn't signaling a bear market, but rather a temporary correction driven by shifting narratives. He points out that despite their stock declines, Tesla and Nvidia remain industry leaders, with Tesla strengthening its position in robotics and AI. Lee argues that the broader sell-off is being fueled by ETF-driven panic selling, not a real deterioration in company fundamentals. On the crypto front, Lee suggests Bitcoin's long-term outlook remains strong despite its recent pullback. He emphasizes that if Bitcoin continues gaining traction in global finance, it could eventually rival gold's market cap, leading to a significant price surge. However, with Trump's crypto reserve plan introducing new uncertainties, investors are left wondering, is this the time to buy the dip or brace for further turbulence? As the Fed remains behind the curve and markets digest political and economic shifts, the big question remains, is this a buying opportunity or the start of something bigger? Let us know your thoughts in the comments below. Share this video and don't forget to like and subscribe.